morning, viewers, and welcome to your market review program where we discuss the financial and capital market as it relates to the economy. In this edition on Tuesday, 12th January 2021, we'll be looking at the opportunities and risks in the Nigerian capital market for 2021. What an interesting year we already have before us. And to have this conversation with us, joining us virtually, is Professor Uche Uwaleke, a professor of capital market studies at the Nasarawa State University. He's been in a lot of spaces. I mean, in the fiscal space as a former commissioner for for finance in Imo State, and also the president of the Association of Capital Market Academics in Nigeria. Nice to have you on the show, Prof.
Yeah, thanks very much. My pleasure indeed. Yes. Happy New Year.
Yes, same to you, sir. Now, last year, experts and analysts and even operators in the market were looking at the impact of the pandemic and other macroeconomic factors and issues would lead the equities market to close negatively, but things turned around, and of course, the Nigerian Stock Exchange closed year 2020 with 50.03% year-to-date performance and hit 40,000 basis points plus. That was quite remarkable. But looking at your article published on ProShare, gazing into 2021, you outlined some factors around monetary and fiscal. If you could just, in few minutes, highlight what were those key factors that shaped the performance of the equities market last year.
Yeah, thanks once again. Let me say that principally, it was the favorable policy of the central bank that turbocharged the market in 2020. I like what you used to say, against all predictions, defying all estimates. The market surprised. It's surprised on the upside. And if you come to think of it, in March, when the market fell, it fell due to the COVID principally, because the market has started on a positive note in January. And when the COVID index case was announced in February, the market tanked. And that plunge also continued in March. In March, we had the worst performance of the equities market. But there was a gradual recovery and a slight dip again in June. And thereafter, the market headed northwards. Strong growth was recorded in the last quarter between October and December. And to emphasize the point I made earlier, it was principally the central bank's deliberate effort to engender a low interest rate environment. So we saw fixed incomes drop in terms of return, and investors, of course, shifted preference to the equities market. Of course, there were other factors, especially towards the end of the year. At the end of the year, we saw some semblance of stability in the macroeconomy when the federal government submitted the appropriation bill, in good time. There were also favorable news from abroad in terms of the oil price. Oil price, started recovering, crossing the $50 mark. The vaccine prospect, was also a factor. So generally, if you look at the external factors and then the internal factors, the central bank interventions, and also the federal government interventions, all of that also injected liquidity into the system. And when you have liquidity in the system, what usually follows is that interest rates drop. And when that happens, the equities market, becomes the toast of investors. And interestingly, Abasi, I must mention here, interestingly, much of that action came from domestic investors, namely, especially institutional investors and also retail investors. So that's quite commendable, unlike what we saw in 2019.
Yes. So let's get into 2021 now, and the big story already on ground is the demutualization of the Nigerian Stock Exchange. we just got the announcement of Mr. Oscar Onyema, Mr. Temi Popola, and Ms. Tino Adeawe as various CEOs and heads of the various segments of the Nigerian Stock Exchange. How is this demutualization going to really set the pace for the equities market in terms of its activities for 2021?
Well, the studies on demutualization, impact of demutualization on stock markets generally, they have brought out mixed results. In some of them, especially in developed markets, you hear the impact is positive. In other markets, it's not this neutral, so to say. And in some others, they will also tell you that demutualization would have the effect of increasing transactions cost, for example, and would also have the effect of lowering the standard of regulatory oversight on the part of the exchange. There was this recent study I saw by some scholars at the Arizona University, talking about the impact of demutualization on firms quoted on the American Stock Exchange. And they found that in terms of regulatory oversight, that reduced. But overall, I see that as a major positive for the Nigerian equities market. Number one, it will enable us to join the club of demutualized exchanges. As you know, since 1993, when the first demutualization exercise took place, that of the Swedish stock exchange, Stockholm, in 1993. Since then, we've had a raft of demutualization, across the globe. Converting from mutual owned companies to companies limited by shares. So I see the demutualization of the Nigerian Stock Exchange as helping us to join the global trend. And of course, that will also mean increasing the confidence because one thing it does is that there is this evidence that shows that demutualization actually improves the corporate governance of the exchange. Yeah. So the governance structure is improved. And so that should foster some confidence in the investors. But again, of course, too, that given the challenge we have, the technological challenge that businesses are facing, that the exchange is right in demutualization because it will enable the exchange have access to increased capital to upgrade this infrastructure, and of course position it to play its its role. So it will lead to increased capital, funding, as opposed to looking for funds from just members. This time there are shareholders, so more access to funds and increased visibility, increased confidence in the system, and I think all that will be positive for the market. But I'm also happy taking care of the major concern about demutualization, which is conflict of interest. Okay, and the exchange has done that by setting up a separate regulatory entity. Okay, the Nigerian Exchange Regulatory Limited. Okay, so in addition to the exchange itself, the regulatory entity will be independent, even though it's part of the group, will be independent and performing its function. So I think it's it bodes well for the Nigerian stock market.
Yes. One issue you raised about looking at 2021 was the need for the enabling environment to attract more activities in the primary market, like listings. Want to see more IPOs come on board. And in ProShares analysis of the top performing stocks and the low performing stocks, the number one for 2020 globally was the Nasdaq, because we saw tech companies that did very well amidst the pandemic, whether it's Apple, the Facebooks, all those companies that are tech-driven were key drivers of activities and brought value. What would you like to see in terms of the enabling environment that we can really attract more primary activities and listings, particularly from sectors like tech, oil and gas, power, and even down to agriculture, where experts say that we're still yet to formalize that sector as is expected.
Yes, you see, that brings me to the point that if you notice, our market was about the best performing stock market in the world in 2020, as reported by Bloomberg. Okay. But that also, the flip side of that is also the fact that it presents the highest risk, because in finance, the golden rule is the higher the return, the higher the risk. So we don't tend to look at that other side. Okay, what that means too is that our market is highly risky. And that's because of the concentration of listing. Okay, a situation where just 6 companies control the substantial share, in my view, a huge dose of unsystematic risk. Okay, so you look at that performance by this exchange and you discover that the industrial sector and the telecom sector, constituted the bulk of it. So if you remove Dangote Cement, for example, you remove MTN, okay, you remove Boa Cement probably, okay, then you will notice that the thing will go down. So that is the risk. And so the challenge remains how to diversify the listing. Companies are listed to reflect the diversified nature of the economy. Just as you have said, there is need to attract multinational companies, high-tech companies in the agri sector. Interestingly, the few ones there on the exchange did well in 2020. Talking about Presco, Okomu Oil, livestock feeds, and so on. And that's because of the government's favorable policies, towards agriculture. So attracting more listing is very key. And the government has a key role in that process. And that key role will be, putting in place some incentives that will make companies say, yes, let me go and list. The other issue too has to do with the macro environment. I remember when MTN, during the time MTN was being lured to list, MTN kept saying that they would list when the environment was favorable, okay? When the macroeconomic environment was favorable. So if you have a stable macroeconomic environment, if you have a low inflationary environment, for example, and you have an environment where insecurity is not an issue, okay? You have an environment where foreign exchange too isn't a real problem for businesses. So these kinds of environments will be favorable to attract, foreign companies, to list, include the alternative securities exchange market was launched. Yes. You notice it's just few companies that are there. Yeah. Okay, and yet this is a country. Yes, this is a country that has, millions of micro, small, and medium enterprises. So the opportunity is there. It's a huge opportunity that we have. South Africa, an economy that is now smaller in size than that of Nigeria, is boasting about close to 400 companies listed on the Johannesburg Securities Exchange. Yes, but in our own case, we are talking about just 166, or thereabouts. And the majority of them are inactive. Most of the time, when you look at stock exchange trading reports, over 60% of the companies there are not active. Okay, so these are some of the challenges that the market is facing. So there is need for us to attract more companies to list, because that is the way you can actually bring about capital formation. Yeah. When you have these companies list and they come to the primary market and issue shares. I'm not talking about secondary now, which is just a redistribution of shares. Capital formation actually happens in the primary market. When companies come to list, they issue shares or they issue bonds and raise this money for expansion purposes. Yeah. Jobs are created. So that is when the capital market begins to play its role, in economic development. So there's no doubt about that at all, that we need more listings on the not only the Nigerian Stock Exchange, but also on the OTC, the OTC NAST.
Yes.
Yeah, beautiful.
Yeah, and another interesting observation was the domestic, like you rightly said, domestic investors, portfolio investors, they were on the top side in activities compared to being the case of being dominated, market dominated by foreign portfolio investors. Do you see that trend continuing in this year?
Yeah, yes. You see, that's one of the positives of the COVID, if you like, for the equities market. But before now, yes, before now, foreign investors, have always dominated. If you look at 2019, for example, according to the stock exchange, domestic and foreign portfolio reports. Yeah, you find that foreign investors, but in 2020, the reverse became the case. So domestic investors now held sway. So what that means is that our market is actually resilient to that extent. Okay, unlike before, when the market will go down each time foreign investors left, they were more or less driving the market. But this time around, domestic investors stayed put, and that was because as I said earlier on, these investors now found heaven, safe heaven in the equities market. So if you look at the returns on a risk-adjusted basis, okay, returns from the equities market, if you adjust for risk, if you adjust for inflation, okay, they are quite higher than what you get from the equities, from the fixed income, including money market generally. So that's the major thing that encourages domestic investors. And going forward, I want to see that trend continue as long as the policies of the government continue to favor investments in the equities market. So that is very key. But anytime our people discover that it is better to put money in treasury bills, risk-free assets, okay, and earn 15%, nobody will touch the equities market any longer. And it's not just the equities market, including even real investments. Okay, why would somebody go and use 50 million, for example, to set up a micro enterprise with all the challenges, all the infrastructure challenges, and the headache, when the person can put that money in treasury bill and earn 15%, at that time? So the situation now is a lot better for the Nigerian economy, and I want to enjoin the Central Bank of Nigeria to continue in that direction. Remember too that the CBN's loan-to-deposit ratio of 65% also helped to inject liquidity, in the system, because according to the Central Bank of Nigeria, aggregate credit to the economy, especially the real sector, increased as a result. And of course, whenever you have increased liquidity, some will find its way into the securities market, especially the equities market.
Okay, definitely. That takes us quickly to the fixed income and the bonds market. You talked about the fact that the CBN policies helped the equities market, but look at the fixed income market. It's really feeling the heat of the low interest regime. Like you said, if I put 15% and I had 50 million naira, I know what I'll get at the end of the year. So how do they now navigate in that regime where the central bank is pro-growth, is looking at increasing credit to the private sector, support the real sector, and also stabilize the economy, but we're having this low interest regime for operators in the fixed income and money market?
Yes, you see that the trade-off will always be there. That trade-off will always be there, and it is for us now to determine what our priorities are. Now, if you look at the fixed income, let's take the long end side of it. That's the bonds. Okay. If you look at the bonds market, for example, the government is dominating there. Okay. And the government's activities in that market, have tended to crowd out the private sector. How many companies today, come to issue bonds? So government dominates that. And to a large extent too, the policy of lowering interest rates such that interest paid on loans, comes down, has also favored the government. If you look at the 2020 implementation report, budget implementation report of the government, the latest one is that of a half year 2020. It says there clearly that the debt service for first half of 2020 was much less than what was projected. Okay, and that's because of the lower, interest rates the government was paying with respect to bonds. Now, if you look at the 2021 budget, the government has also voted 3.3 trillion for debt servicing alone. Yes. And if you look at the composition of our debt stock, over 70% of that is FGN bonds. It's FGN bonds, over 70%. Okay, so what that means is that if rates are lower, it will be cheaper for the government to borrow. So it favors the government in a way. Okay, and that is why I said this policy needs to be sustained. The policy of lowering rates in the fixed income, because the moment these rates go up, especially in the short-term aspect of it, if you look at once rates go up now in treasury bills, I can tell you people will no longer indulge in real investments. Okay, so I think the central bank's approach is a good one. Should be encouraged, and that is what will also sustain the market in 2021. Because the moment interest rates begin to go up again, then we'll also have the challenge. Central bank will also have the challenge of tackling inflation, and the rest of them by further increasing the MPR. Okay, and then we come back to square one. And I tell you, I don't see the market, equities market, performing the way it did in 2020. Okay, it's not going to happen. If you look at history, experience shows that there will be a pullback in 2021. Certainly be a pullback in the sense that the market has gone very, very high. And I talked about risk earlier on. And come to think of it, this was a market that was down by 14% in 2019. Yes. The market, yes, was down by as much as 14% in 2019. In fact, since 2014, it was only in 2017 that we had that outstanding performance of 42.3%. So since then, it's been down. Yeah. And for the market to now come up and post 50%, 2021 will be a descent. So we expect a descent in 2021.
Now let's get to an area that I know you've been speaking extensively on. We recently even published a story around what you said around states, private sector assessing the debt market. You actually highlighted the fact why a lot of states cannot even assess the debt market. You highlighted the fact that high debt ratios and of course the issues of IGR, internal generated revenue, are those factors that really affect them from assessing this market. But you called for policies that will, from the monetary policy side, that will be a disincentive for states to be leveraging the financial market that provide those short-term financing. But Edo State is one of those states that we're looking at that would definitely assess the market with about 25 billion naira bond issuance. I know that, yes, there are factors, but isn't it still a veritable place for states to assess the market, particularly for those that don't have a high debt and have this good IGI flow?
Yeah, absolutely. Absolutely. You see, one mistake that some of the states make is something you can pin to funding mismatch. Funding mismatch is a situation where, again, I'm talking from experience, you find some state governments going to take loans from banks to think of financing projects, long-term projects. Why would a state government take a loan from bank to finance a road project, for example? Or you take a loan from bank to put in schools, to construct schools. How do you repay? Okay, so funding mismatch has been a problem of course, you know, to give the impression to the citizens that you are delivering dividends of democracy. Some governors get that temptation because, number one, bank loans are easier for them to arrange. Okay, from my experience while I was Commissioner for Finance, you find a lot of banks come to you with proposals. They want to lend money to you. Come and borrow, come and borrow. Okay, but because of the discipline that we had and the support I had from my principal, the governor, we didn't succumb to that. Okay, because we knew that for you to finance any long-term project, you will need to have long-term funds, and the capital market presents that opportunity. Lagos State, for example, is the highest debtor state in Nigeria. Okay, yes, but it's always able to access the market. Okay, I think just recently Lagos State went to the market to look for 100 billion. And each time Lagos State goes, of course, the response is usually encouraging. Okay, and that's because of the, if you like, the ability of Lagos State to also generate revenue and to ensure that obligations to bondholders, you know, are met. So the high debt is one of them. IGR is also the other. But it's also important that the Central Bank of Nigeria, you know, should put in place measures to make it difficult for states to, you know, obtain these loans from banks. Because once these restrictions are not there, you find a lot of, you know, chief executives of states going to get these loans from banks, okay, you know, and thereby putting the states, you know, yes, in that trap. So central bank has a role to play, and that role will be to put in place some measures that will make it difficult for states, you know, to get loans from banks, and including perhaps even monitoring, you know, the use of such facilities. The other one too is awareness. I can also tell you that some states, okay, let me just say some states are not aware of the potentials that the capital market, you know, presents. So awareness is also there. I remember while I was there, okay, we were trying to organize something like a workshop for all finance commissioners. Then I was discussing with the then acting DG on how to organize something for all the commissioners of finance, you know, to let them know the need to convince their chief executives to access funding, long-term funding, you know, from the capital market, because that is where you get the funds for roads, okay? And you don't borrow. Ideally, you don't borrow to pay salaries. You don't borrow to, you know, for consumption purposes. But that is what we see. Anytime state governors are held in the neck by labor or something, they go to banks to, you know, to take loans to be able to pay salaries. So that should be discouraged.
Definitely, definitely. And just in 1 minute, Professor Uwaleke, is a concern. The budget report, last budget analysis said 11 states had their overheads higher than their capital expenditure. Based on your experience, what is the best strategy to really ensure that overheads are reduced, to ensure that investments are put into things that create opportunities in the economy, like capital expenditure?
Yes. Interestingly, if you look at this year's 2021 budget for many of the states, I tried to look at, you know, it would appear that some of them are beginning to understand that development is driven by capital expenditure. So you find that for most of them, the capital component is higher than the recurrent, okay? And although I noticed that for one or two of them also, the budget, what they have as budget, in my view, appear unrealistic. Okay. Now, the ideal thing is to first ascertain what your IGR is, what your capacity is, and then use that to develop your recurrent spending. So IGR should cover recurrent spending. And then use the assumptions by the federal government with respect to oil price, oil output, exchange rate, okay, to now prepare the one that you will need, you will be expecting from the federation account. So whatever you get from federation account is now used for capital. Okay, so the proper matching is ensure that you don't borrow to finance recurrent expenditure. Okay, recurrent expenditure should be met from IGR. Yeah. And then capital expenditure can now be done from money received from the federation account, in addition to long-term borrowing. That is the way, that is the formula.
Yeah. That's the formula,
yes,
going forward. Yeah. Thank you very much. And definitely we hope to see more activities from the private sector in the debt market, particularly commercial papers and bonds. Last year we saw several activities, Guinness, Dangote, Mixta, a lot of them were on board, and hopefully that trend should continue.
Yeah. I said earlier on that the government dominates the bonds market, and tends to crowd out the private sector. If government is issuing bonds, for example, at 5%, remember, government security is gilt-edged security, is a risk-free asset. Okay, if government is borrowing at 5%, the private company, okay, can only borrow at a rate that is higher than that of the government. So anytime you find government in competition with the private sector, the government usually has an upper hand. And that's why you find that most companies would prefer to do equity. Okay, they see equity as a cheaper source of fund than debt capital. Remember too that when you issue bonds, you are committed to paying interest. But when you issue equity, you must not pay dividend until you make profit. So companies prefer equity, and that's why you find that even when they want to raise funds to recapitalize, they do so via equity. But of course, you need a proper mix. The companies need proper mix, proper capital structure in terms of equity and debt. It's not only equity capital, but companies too, in corporate finance, we'll talk about capital structure. What is the proper mix of equity and capital? So a company as part of a balanced, if you like, portfolio should also have not only equity, but some sort of debt coming from the capital market, not debt from the banks, because it is the one from the capital market that usually, longer term. Of course, big companies like the Dangotes, can afford to, go issue debts. I'm not talking about short-term debts. I'm not talking about commercial paper, okay? Because commercial paper is money market family. That's short-term. Use commercial paper for your working capital, But for redevelopment, it is, bonds.
Now, when we look at the OTC securities, in 1 minute, what are the things you see that will really shape that market for 2021?
Yes, OTC market is growing. It's developing in Nigeria. Remember that before 2013, we didn't have the NASD, we didn't have the FMDQ. Okay, they all came on board after 2013. And since 2014, since they opened their shop in 2014, I would say they have been doing well against all odds. If you look at the market turnover of FMDQ, for example, it speaks of a success story. FMDQ has done well, no doubt. NASD too has, of course, a number of challenges. In the sense that the number of listing is still not where it's supposed to be. Yeah. Okay, given the size of our economy, just 40 companies are listed on the NASD. But in spite of that, I want to also commend the the management of that company, because they have been very innovative. Innovative in the sense that I'm aware that there is this portal that they have, the NAST Venture, Limited,
Venture Ramp.
NAST Venture Ramp. Yes, a crowdfunding portal. So that's a very good initiative, and I'm sure it has very huge potentials. The other portal too, the NAST Enterprise portal, is also quite good. So as I said, they've been quite innovative. But I would expect them to, if it's possible, to not to bother about categorizing companies in the red category. Okay, they have this blue, pink, and red category. Red is for companies that fail to disclose information. So why should a company fail to disclose information or not disclose information and be admitted on an exchange? So I don't think that one should stand. So it's good to say you have blue, you have pink, but to say you have red, in my view, it wouldn't augur well for transparency in the market. Remember, NAST says that it provides unlisted companies the opportunity to to trade in a transparent way, and transparency also requires disclosure. Okay. Now, one other challenge I see that NAST has is that is just NAST is focusing on securities that are registered with the Securities and Exchange Commission. There are a number of securities out there that are not have laws, regulations that will, help improve the OTC market, in Nigeria. I think they're doing well. They need to be supported, through the right laws, through the right, regulations.
Then 1 minute for the commodities market. There's need for synergy. What other things you'd like to see happen so that this market deepens our ecosystem, the capital market, and the economy? Because like this year, we'll see the LCFE kick off, the Lagos Commodities and Futures Exchange. But what other things do you see shape the commodities market for 2021?
Yeah, as you know, the commodities market is meant to support the non-oil sector of the Nigerian economy and help in economic diversification. Yes, thank God the infrastructure is also improving, is expanding. Okay. Before now, we had just the Nigerian Commodities Exchange, but today we have the AFEX, we have the Lagos Commodity, the recent one, Lagos Commodity and Futures Exchange, and there's also one in Kano that is waiting for license. So they are all coming up. Again, the enabling legislation, enabling laws are required. I'm aware of the warehouse receipt bill that has been in the National Assembly for long. Okay, that warehouse receipt bill, yes, we go a long way in facilitating the activities of commodities. Of course, there are major legacy issues that revolve around infrastructure, for example. You can't talk about commodities in Nigeria without talking about the transport system in Nigeria, because you will have to move the commodities, from the farms, to the farm gate, and from the farm gate possibly to the warehouses. So the transport system, so the entire commodities ecosystem includes, functional infrastructure, especially transport. Okay, and the infrastructure also would include a proper, standardizing institutions. Okay, institutions that standardize these commodities. It's not just the Standard Organization of Nigeria, for example. Okay, so we need the market needs, again, skilled participants, skilled players. I'm aware that there is this commodity brokers, association of Nigeria. So a lot more people are required, in that sector to be able to boost the market. So the major challenge there I see is the challenge also we have in the agri value chain, in Nigeria. And the good thing is that government is trying to also promote agriculture, but not the smallholder type of agriculture, because that will not enable the commodities market. Because one of the challenges they have is aggregation. Okay, so we need large scale, farming. Okay, they require warehouses, particularly the Nigerian Commodities Exchange. And one thing I would recommend for Nigerian Commodities Exchange is partial privatization. It's been in the hands of the government for a long time. Okay, look at Afex, look at the Lagos commodity. So if we partially privatize the Nigerian commodities market and then put in place an enabling environment that creates a level playing field for all of them, I think the commodities ecosystem, trading ecosystem, will pick up. As I said, it requires a lot of incentives in the agri value chain, because if they don't produce, okay, you won't have what to take to the warehouse. And as I said, the warehouse receipt bill is very critical, because a point comes where when that receipt becomes now the instrument. So you now move from the spot market, okay, to the futures market, where physical commodities may not really be the issue. So commodities markets, very critical aspect of the capital market ecosystem, should be developed alongside the other products.
Yeah, and Prof, finally, the unclaimed dividends funds, is that a major debating issue in the country? What is your take on this? Because I remember in a discourse, you and some experts were looking at a legislation that covers unclaimed assets. And based on your experience in other countries, in Europe and Asia, what's the best approach concerning this unclaimed dividend fund that the federal government, through the Finance Act 2020, has rolled out?
Yeah, interestingly, even before this whole debate began, I started mentoring students that is working on unclaimed assets. The PhD student is doing a comparative study of unclaimed assets in Nigeria and the UK. And of course, what emerged, what is emerging, because the study is still on, is that we don't have an unclaimed asset law in Nigeria, okay, unlike what we have in the UK. So unclaimed dividend is part of unclaimed assets, okay? Apart from the dormant bank accounts in the dormant balances, you also have unclaimed prices. You also have unclaimed pensions, okay? You also have unclaimed payroll or paycheck, and so on. So unclaimed assets is a basket of assets, really. But in Nigeria here, the emphasis seems to be on unclaimed, dividend. I'll also tell you that I was at the public hearing before this Finance Act, 2020 Finance Act, was signed into law. Okay, I went to represent the Chartered Institute of Bankers of Nigeria. I'm the current chairman of CIBN in Abuja, and the president of CIBN, the president of CIBN requested me to be there. Okay, so of course, the position of central CIBN is to support the Finance Act. Okay, but on my own, as a person, I spoke specifically with respect to the unclaimed dividend section. Yes, because of my interest in the capital market. And one of the things I noticed was that where the bill was talking about the composition of the governing council of the trust fund, it only talked about the finance minister and the co-chair. So I was the one, the video thing is there. When I was making my presentation, I said that you can't have this kind of governing council without including the Securities and Exchange Commission, DG. So, and I'm happy that in the act that came out, the DG SEC, was included. So my suggestion at that public hearing was taken, apparently. Okay, so my whole position on it is to say, I think I support it because it's not only talking about unclaimed dividend, it's also talking about dormant bank account. So all that is saying is that after 6 years, that the government will take it over as a special loan and if you like, hold it in trust for those people. So anytime the owners also, anytime they come to claim the funds will be available to them, and government has not defaulted in any of its obligations. Okay, so as I said, it's not just unclaimed dividend. Otherwise, the argument could be let the registrars or let the companies manage. But again, if you say let registrars or let the companies manage, what happens? The big question is, what happens when the company is no more? Okay, government is a continuum. Government is in the best position to hold it in trust. Okay, now the position I would have adopted, I went there to canvass really was the model of the UK. In the UK, you have a reclaimed asset limited company that was formed to manage the assets in perpetuity. In Kenya also has a similar law. Kenya set up unclaimed asset authority. Unclaimed asset authority. That unclaimed asset authority has a responsibility to manage the unclaimed assets, again in perpetuity. Okay, so these authorities or these companies are separate from government, and their role is just to manage the unclaimed assets. So that was the thing I thought too we should have here in Nigeria, but the government is saying they want to do that through the DMO, which what I would rather recommend is probably an extension of the dormancy period. Instead of saying after 6 years, the dormancy period could be extended to say 10 years, because the law, what we have in the KAMA, even talked about 12 years, initially. So I also want to tell you, Echo, that in the US, of course, in the US, a lot of states
have their own provisions.
Yes, excheatment law. It's called excheatment law. In some states, in states like any unclaimed property in the United States, you can check that out. In the state like Georgia, in Georgia it's after 5 years. So in some states it is 2, in some other states it is 5. Okay, so what that means is that this is the practice too in the United States. It's not new here. If the government says it wants to hold the money, okay, and then anytime the owners come, they will also release the money. But what is important, in my view, is for us to also make deliberate efforts to track the owners of these funds.
Yeah.
Even when it is taken over by the government, there should be a deliberate effort to reunite those owners. Okay, so in a nutshell, I support it, like the dormancy period extended, and I will also want a situation where even after the thing is taken over, the DMO, the governing council, and interestingly, the governing council includes representatives of shareholders, representative of the registrar of companies, registrars, the SEC DG, MD of NDIC, CBN governor, and shareholders. So I think the composition is fine. Is fine to that extent. So the idea of asking registrars or companies to take over these things, as I said, that one has limitations, don't have a life in perpetuity. What becomes of the fate of those funds? Okay. Now, finally, I want to say that this is an age of technology. You mentioned it earlier, yeah. And the market, should continue to leverage, technology. And I'm happy with this demutualization, the exchange will be in a stronger position now to invest in technology. These days, you find, I'm sure you've heard of centralized finance and decentralized finance.
Yes.
Centralized finance, the traditional one based on it, and then decentralized finance. Okay, decentralized finance is the one that leverages the technology we have these days, whether artificial intelligence, whether distributed ledger technology, the blockchain, whether data, and then cloud computing. So all of this can be also applied in the capital market. We don't need to wait. Okay, this is the time to begin to research, begin to collaborate with fintech companies, to ensure that we deliver value in the capital market, collaborating with fintech companies.
Thank you very much, Professor Uche Uwaleke. Very robust conversation that shows that 2021 holds a lot of prospects, even though we also have identified some of the risk that has to be mitigated. And in closing, I would agree that we need to have an unclaimed assets law. I think that will really help in encompassing everything, legislation like you do, given comparatives from UK, Kenya, and other climes. Well, thank you very much, Professor Uche Uwaleke, Professor of Capital Market Studies.
You're welcome.
Nasarawa State University, for this very incisive conversation, looking at the capital market and what we should look out for in the year 2021, covering all the various segments of the ecosystem. Looking forward to a more interesting conversation with you much later in the year. Well, thank you once again, and all the best as you lead the academicians who are carrying out capital market studies in the country. And that will be all for today's edition of the Market Review. You can join the conversation. Log on to our website, www.prochange.com. Yes, to get the further conversations around the capital market and what will be the opportunities and risk. We have a very rich website there. Click on markets, get all the updates from equities to the fixed income and bonds to the commodities and even the unlisted securities. We have them all covered for you. Also, follow us at The Analyst and also at ProShare for all those updates on Twitter and at WebTV. Till we come here again, thank you for watching. Have a nice day and stay safe.